What's up, YouTube family? Welcome to Official Talkology. Today we will be talking about the third series, Choosing a Business Structure. Now, the first sets of videos, the first video covered the 7 steps to owning your own business. The first series covered having a vision. The second series covered choosing a business entity. And now we are on the third series, choosing a structure for your business. Yes. Now, the structure aspect of it, there are a total of 10 structures to choose from. Okay, so before we get started, don't forget to like, comment, subscribe, as well as hit the notification bell in order for you to get the updated videos, the latest videos that I will be releasing. Now let's get into the meat of it all. The 10 structures, I will list them and I will give you as well as some examples or some meanings to them so that you can truly understand each structure or which structure is best for you. The first structure is considered a sole proprietorship, meaning there's only one person involved, only you. Meaning that if you do not want to use your Social Security number to report it to the Internal Revenue at the end of the tax year, you can file for an EIN with the Internal Revenue, which gives you a unique number to utilize as an employer number. That way you don't have to use a Social Security number for it. The second option that is available is considered a partnership, meaning that you are in fact liable for everything as well as your partner, because it's more than one person involved. So a sole proprietorship as well as a partnership, you will be responsible personally for any liability involved. So if a client chooses to sue you, guess what? Your personal asset is affected by that. So please think through the structures of which one you want to choose. The third option available is considered a limited liability company, meaning that's when your assets, your liability, your personal assets and liability are in fact protected. And it can be more than one person or more than two, individuals, which means that you can have yourself, your partner, and two more folks or more than that. However many individuals you want to be part of your entity, of your company, you can do that. And so you have the option of choosing a fourth option, limited liability partnership, meaning if you just want to keep it two people instead of having multiple individuals being part of your business, you can turn it into a limited liability partnership, and that way your personal assets is protected as well as your partners, meaning that if anybody chooses to sue you guys, they only sue the company. Both your personal assets are not affected by it, but you have to share a percentage amongst, or you have to agree upon a percentage of what each person is responsible for. It may be a 50-50 percentage, or it may be a 40-60, or it may be a 70-30. Whatever the case may be, you two have to make a determination how the percentage wise is going to be split down the line. The fifth option is considered a corporation. Now, there are a number of types of corporations, but the first one we're going to talk about is a traditional corporation. According to the Internal Revenue, it's called a C-CORP, meaning that it is the strongest structure to choose from, which it in fact protects everything. It protects you, it protects you personally, it protects your board of directors, it protects your employees, but it affects the business. If anything were to go wrong, only the business is liable from that. Okay, so now the next option available is considered an S-Corp. I call it a special type corporation, meaning that you are not you don't have to endure the double taxation. It prevents that from happening, meaning that a traditional sole proprietorship or a partnership, typically you only file just for the corporation alone. And so that way you're not taxed double. So not only did you use your own personal funds to help the business, but you don't get the benefit of it all at the end of the tax season. As an S Corp, you still file an S Corporation form, and then you can also transfer the liability or the loss incurred onto your personal tax return, as well as if there's any profit involved as well too. You transfer that over onto your personal 1040. That will also help you from being double taxed. Okay, so now we've gone through a sole proprietorship, we've gone through a partnership, we've gone through a limited liability company, we've gone through a limited liability partnership, we've gone through a traditional C-CORP, we've gone through an S-CORP, which I call it the special type corp. Now we have the next option as a B Corp. Now a B Corp is unique. It's a non-traditional type of structure. A B Corp benefit, the point of a B Corp is that the public have to benefit from it all. Meaning that at the end of the tax season or tax year, you have to file an annual report indicating what is it that you have done throughout the year that benefited the public. So a B Corp is something that have to benefit the public one way or another. You have to show proof that whatever profit made or loss incurred, that it was due to the fact that some sort of benefit to the public, you offered some sort of anything to the public. Whatever function you had, it benefited the public of some sort. So you must, under no circumstance, I mean, you have to show that the public in fact benefited from that. The next option, the closed corporation, meaning that it resembles the B Corp, but the difference is they cannot be involved in any type of trading publicly. They cannot. Whereas the B Corp, you have to provide or indicate that whatever you do benefited the public. Whereas a closed corporation, you do not have to do that at all. And so now the next option that is available is considered a non-profit organization. Meaning, if you've ever heard the term of 501c3, it has to somehow, they're either a religious group, they are a scientific group, they are an educational group. Whatever the case may be, they are considered tax exempt. Meaning they have to go through the Internal Revenue for them to determine if they qualify to be a tax exempt company or to be structured that way. And so the last option available is considered a cooperative, meaning that a cooperative is owned and operated for the benefit of those using its services, but they the board of directors and the officers pretty much are running the cooperative decision making. So while the regular members have only voting rights, the cooperative pretty much are the board of directors and the officers that are pretty much running the day-to-day operations, while the traditional owners only have voting rights, and that's it. But of course they control what the cooperatives do or not do. Okay, so, and if you have any questions about anything that I've discussed today, please leave a comment. I will answer your question as quickly as I possibly can, and Don't forget to subscribe. Don't forget to like. And don't forget to leave me a comment, as well as hit the notification bell in order to get my next video coming up, okay?